Hey folks, welcome back. Pharmaceutical giants Eli Lilly and Novo Nordisk have been dominating headlines in the weight loss and diabetes treatment market. Both recently reported their quarterly results, giving us fresh insights into how these companies are performing and where they might be headed. Today, we're going to dig deep into their numbers: revenue, growth trends, profit margins, returns on invested capital, and valuations, to figure out which one looks like the better buy right now. By the end of this video, you'll know how these two titans compare, what challenges and opportunities they face, and which stock edges ahead as the more attractive investment at this moment. So let's jump in. This content is for informational purposes only and is not intended as financial advice. Always do your own research or consult a financial advisor before investing. To understand the bigger picture, we need to go back to 2015. At that time, Eli Lilly was bringing in about $20 billion in annual revenue. Fast forward to today, and that number has more than doubled, reaching $53.3 billion. Novo Nordisk, meanwhile, started at $15.7 billion and has now climbed to $49.3 billion. That's a 12.8% compound annual growth rate for Novo Nordisk versus 10.9% for Eli Lilly. However, recent performance tells a slightly different story. Eli Lilly has been outpacing Novo Nordisk in revenue growth lately, and there's a reason. Novo Nordisk has warned investors that its revenue growth for the second half of 2025 will be much weaker than expected. One major factor hurting Novo Nordisk? Direct competition from Eli Lilly. Eli Lilly's weight loss and diabetes treatments are currently outperforming Novo Nordisk's offerings. On top of that, Novo Nordisk is also facing a sales hit in the US due to compounded versions of these drugs still being available, despite supposed restrictions starting in May 2025. Industry estimates suggest that around 1 million people are using these compounded alternatives. While this affects both companies, Novo Nordisk appears to be taking the bigger hit. Both companies are ramping up production to meet surging demand and working on new treatment formats, moving from injections to oral pills. But here's where things get interesting. Eli Lilly recently shared trial results for its oral pill version, and investors weren't impressed. The pill achieved roughly 12% weight loss after a year, below the 15% that management had previously indicated. That shortfall could cost billions in potential sales and give rivals like Novo Nordisk and Viking Therapeutics an opening to catch up. Efficiency matters in pharma, and revenue per employee is one way to measure it. Eli Lilly generates about $1 million per employee, while Novo Nordisk brings in roughly $667K per employee. This suggests Eli Lilly's workforce is more productive, likely due to operational advantages in both R&D and manufacturing. Operating profit margins are impressive for both, 47.7% for Novo Nordisk and 43% for Eli Lilly. But the trend is key. Eli Lilly's margins have surged from 31.6% to 43% in recent years, thanks to the GLP-1 treatment boom. Novo Nordisk, on the other hand, has seen a slight decline and has even lowered its operating income forecast for the rest of 2025. Notably, they've been silent on 2026 guidance, which has made investors a bit uneasy. That said, Novo Nordisk could still see upside if its legal push to stop compounded drug sales succeeds, potentially freeing up that 1 million person market for the major players to split. Another key measure is return on invested capital, ROIC. Eli Lilly edges ahead with 27.8%, just above Novo Nordisk's 27.6%. While close in percentage, the trends differ. Eli Lilly's ROIC has been climbing, while Novo Nordisk's has been slowly drifting downward over the past decade. This is important because each additional customer now contributes significantly to profit. The big R&D investments in GLP-1 treatments have already been made. Both companies have late-stage treatments in development that could be worth billions if approved. This competitive race is far from over, and any breakthrough could quickly shift the balance of power. Using a discounted cash flow approach, Novo Nordisk's fair value comes in around $127 per share. That's after factoring in recent downward revisions to sales, profit, and cash flow forecasts for 2025, and it's still far above the current market price of about $51. For Eli Lilly, the fair value estimate is $1,235 per share, compared to a current price of roughly $625. While I lowered free cash flow expectations starting in 2028 due to the weaker oral pill results, the stock still looks significantly undervalued. On a forward price-to-earnings basis, Novo Nordisk is the cheaper of the two, trading at about 12 times forward earnings versus Eli Lilly's 23 times. Both stocks appear undervalued, and both have strong long-term potential. Novo Nordisk offers the bigger discount by PE ratio, but Eli Lilly currently holds a competitive edge in growth trends, operational efficiency, and ROIC trajectory. If forced to choose just one today, Eli Lilly would narrowly take the win, but it's a close race, and developments in the oral pill market could change the picture in the next few years. That's the breakdown. Whether you're leaning toward Eli Lilly's current momentum or Novo Nordisk's valuation advantage, the next 12 to 24 months will be critical in shaping the future of these two pharma giants. Thanks for watching. If you value thoughtful, data-driven market analysis, be sure to subscribe and follow along for more strategic insights. Have a company or sector you'd like us to explore next? Leave your thoughts in the comments. Until next time, stay informed, think long-term, and invest with purpose.